Hey everybody, it's Eric. Welcome back to the channel. I'm doing another risk-free 0DTE trade. I did something a little bit different today, but I do want to walk you through the entire day. I managed to get into this particular 0DTE risk-free trade, but I had several small losing trades today as well in order to get this. The price action was very narrow, so it was really hard to get kind of a move in my favor. So I took a few small losses, and I'm going to show you those now. I sold, we'll talk about the spreads, but I had sold the spread for 19.15, had to buy it back for 19.40. So I lost 25 bucks. I bought one at, sold another spread at 12.15, had to buy it back for 12.30. I sold one at 8.10, bought it back for 8.85. So I had three, quote unquote losers today for a total loss of $125 or so. But the final trade that I'm in was selling this particular call spread at 1060. Notice it's a little wider. I'll show you the strikes here in a minute. This is a 20 wide spread that basically straddles where price was at the time. And then as it moved in my favor, I was able to sell an offsetting put credit spread that was also 20 points wide. If we take a quick look at the option chain, these are the strikes. So on the call side, I sold the 175 and bought the 195. So this is 20 wide. I got a big credit. And at the time, SPX was trading right basically in the middle. And then I sold a 6190 70, which is also 20 points wide. So it's basically an overlapping iron fly. And the reason I did this is because in the previous videos, you probably seen me build the forest, right? Creating multiple trees. But what happens is you ultimately need let's call it an iron fly and then maybe a butterfly or some other kind of spread. And you end up with multiple entries and you try to get the biggest profit zone. So what I did today was, instead of trying to create several smaller trees, I just wanted to create one big tree by going wider. Now, this means that upon entry, there's more risk. So let me show you what that looks like. So when I first entered the call spread, price was trading right around here in the middle. I sold a 175 call and I bought the 6195 call. So this is a bear call spread in which I need some bearish movement to create profit so that I can sell the offsetting one to lock it in. So you'll notice when I originally took this spread, my max loss is 940 and my max gain is 106. So technically I'm risking $940 and I need that in margin to even take this trade. So it's not no risk upon entry. It's really getting risk free for later in the day. So this is actually why I had to close out of the other trades I showed you, was because I was risking more. And as it went against me, I was okay with losing $40, $50. Let me set up again. And eventually I got one to go in my favor. So this was the initial risk, but as soon as I'm able to cover the max loss, remember this is $940. So in order to cover this, I need a credit of the put credit spread to be greater than that. So when we add in the put credit spread, I have the 965 here, which is greater than the 940. So that covered the max loss here. And that's also covered the max loss here from the previous credit. So when you combine those spreads, I'm basically in a risk-free iron condor, iron fly, whatever you want to call it, some kind of weird thing. But look how wide my spread is. This is very high probability now that I might actually land in here and get the max gain of, let's call it 500 bucks. If you subtract the losses I had earlier, maybe I make more than, closer to 400 bucks. We'll see. We still have an hour and 15 minutes to go, so we'll see where this lands. But I wanted to show you that, yes, there is risk in trying to create a no risk trade. But I managed to get one in, and I like the width I have here. There's a greater probability that this lands in this zone as opposed to having a single, 5 or 10 wide butterfly off to the side somewhere. So work in progress. Let me know what you think. We'll see you in the next video.